Welcome! On behalf of First Guaranty Bank, we have specially crafted this course to discuss managing debt. It is our hope that this class will assist you in understanding the differences in debt and credit, and how debt can affect a person's financial situation. This session should last roughly an hour. Before we start, I would like to mention we will be discussing a few handouts which are part of the Managing Debt Participant Guide. The participant guide is available on our website under additional resources on the financial literacy page. Our first topic is what is debt. We will discuss what debt is, how to understand debts you may have, and how debt relates to your financial situation. You can follow along by turning to page 4 in your participant guide. The key takeaway from this section is understanding your debt is the first step to managing it. What is the difference between credit and debt? They are similar, but as we will review, debt is not the same as credit. Debt is money you owe. You've already borrowed it. Credit is the ability to borrow money. You haven't borrowed it yet. You can use credit to borrow money, which then becomes your debt. You can have credit without having debt. For example, opening a credit card gives you credit. You have not incurred a debt until you use the credit card. You can also have debt without having credit. If you borrow money to buy a car, you have debt. You likely cannot borrow more money using that loan, so you don't have any credit through that loan. These are key terms to understanding debt. Someone who owes money is called a debtor. The person, business, or organization that loans money to the debtor is called a creditor or lender. Many of us make mistakes when it comes to handling debt. Understanding your debt is the first step to managing it. To understand your debt, you need to know who you owe, how much you owe them, so what's the remaining balance, how much the payments are, when the payments are due, and other important facts including interest rate, fees including penalty fees for not following the rules for the loan or credit, such as late fees, prepayment penalties, which are fees lenders sometimes charge if you pay off your loan early, and balloon payments, which are larger than usual one-time payments at the end of a loan term. If you have a loan with the balloon payment, your payments may be lower in the years before the balloon payment, but you could owe a big amount at the end of the loan. You can gather this information on your debts from your credit reports, monthly bills and statements you receive, loan agreements or credit documents, and personal agreements for loans you may have with family, friends, and others who may not issue statements about your debt. Try to gather or determine whatever details you can about the debt. If you're needing a copy of your credit report, visit annualcreditreport.com. You can look at page 5 for examples of how people commonly accumulate debt. Debt can affect your financial situation because you will need to use income you receive in the future to make payments on your debt. This is sometimes called obligating future income. In other words, you'll have fewer choices about how to use your future income because you'll need to use it to repay some or all of your debt. You will generally pay interest and sometimes fees on your debt until you pay it in full. That means you are paying more money than if you paid for the item in cash. You may not be able to reach your goals, or you may reach your goals later than you planned or hoped to reach them. For example, if you have too much debt, you may not qualify for a mortgage or be approved to rent the apartment you'd like. Turn to Apply It, Understanding My Debt on page 6 in your participant guide. You can use this activity after today's training to better understand the debt you may have. Remember, the key takeaway from this section is understanding your debt is the first step to managing it. The next section we will cover is called How Debt Works. we will discuss common debt terminology and how different types of loans work. You can follow along on page 8 in your participant guide. The key takeaway from this section is consider how debt works so you can make informed decisions about it. We're going to go over a few questions to familiarize you with some of the lingo associated with debt. Debt lingo 1. A loan with collateral that the lender can take if the loan is not repaid according to the loan agreement is A. Principal, B. Secured loan, or C. Annual percentage rate. I'll give you a few moments to think about this one. The correct answer is B. Secured loan. For example, a home mortgage is a secured loan because the loan is secured by the home. The home is the collateral or security for the mortgage. If you don't make the payments, the lender can take the home. Debt lingo 2. How much money you borrow is A. Principal, B. Interest, C. Fees. The correct answer is A. Principal. Debt lingo 3. The main cost of borrowing money is A. Current balance, B. Interest, or C. Credit. I'll give you a few moments. The correct answer is B. Interest. Debt lingo 4. A credit agreement that allows you to borrow money from time to time up to a pre-approved maximum credit line is A. Installment loan, B. Revolving credit, or C. Lease agreement. I'll give you a few moments. The correct answer for this one is B. Revolving credit. Examples include credit cards and lines of credit. Debt lingo 5. The total cost of credit on a yearly basis is A. Annual fees, B. Annual adjustment, C. Annual percentage rate. The correct answer is C. Annual percentage rate. The annual percentage rate is commonly called APR and is usually higher than the interest rate. Debt lingo 6. When you borrow a specific amount of money and repay it over a set period of time, it is A. Revolving credit, B. Principal, or C. Installment loan. I'll give you a few moments. The correct answer for this one is C. Installment loan. Examples may include car loans, student loans, or mortgages. And lastly, debt lingo 7. A loan with no collateral is A. A secured loan, B. An unsecured loan, or C. A mortgage. I'll give you a few moments for this one. The correct answer is B. Unsecured loan. Credit card debt and student loans are usually unsecured loans. Now let's talk more about how debt works. It can work differently depending on the lender and whether the debt is an installment loan or revolving credit. You can follow along on page 9 of the participant guide. With an installment loan, you borrow a set amount of money called the principal. You repay the principal plus interest over a set period, which is the term of the loan. You generally pay the same amount of money every payment unless you have a variable or adjustable interest rate. With a variable or adjustable rate, the monthly payment will be recalculated based on the new interest rate. You will then pay the new monthly payment until the interest rate adjusts again. A lender will use factors that include your credit scores and how much of your income is used to pay debts to determine whether to offer you a loan. They will also use these factors to determine what terms to offer, such as the interest rate. With revolving credit, you borrow up to a maximum credit limit. The most you can borrow, the credit limit, is generally set based on credit-related information that includes your credit scores and how much other debt you have. The amount you must pay is based on how much of the credit you have used. You must pay at least the minimum amount due with every payment. That's usually 1% to 5% of the outstanding balance. You can pay more than the minimum. The more you pay, the sooner you pay down the debt, and the less money you pay in interest. Turn to Try It How Installment Loans Work on page 9 in the participant guide. We're going to go over this together. In this scenario, Zoe learns about installment loans. Zoe knew her credit needed some work. She learned her bank offered something called a credit building loan. The credit building loan would allow her to borrow $1,000 and repay it over 12 months at a 12% annual percentage rate, or APR. Her payments would be reported to one of the 3 nationwide credit reporting agencies. As long as she made her payments on time and as agreed, this would help to improve her credit. She thought this sounded like a great deal. Using this scenario and the table on page 10, let's answer these questions together. First, what is the scheduled monthly payment? The correct answer is $88.85 for 12 payments. Next, how much goes to interest from the first payment? The correct answer is $10. Next, how much goes to interest from the final payment? The correct answer is 89 cents. So why does the amount of interest in each payment decrease? Why does the amount of principal in each payment increase? The correct answer is the amount of interest in each payment decreases because it is calculated based on the outstanding balance, which goes down over time. Here's why the amount of principal in each payment increases. The amount Zoe pays each month is the same. Those equal payments are made up of interest plus principal. Because the amount of interest decreases each month, the amount of principal has to increase. There is another activity on page 11 for us to review. In this scenario, Zoe learns about revolving credit. Zoe decides to use her credit card to buy something that costs $1,000. Her credit card has a 12% annual percentage rate, or APR. She doesn't use her credit card for other purchases. Each month, she only pays the minimum monthly payment, which is 5% of the balance. Using the scenario and the table for this activity, let's answer these questions together. First, why does the monthly payment change each month? The correct answer is the outstanding balance changes, so the interest owed changes. Next, after 12 monthly payments, how much money does Zoe still owe? The correct answer is $612.71. Next, how much interest has Zoe paid in total after making the 12th payment? The answer to this is $96.82. What is the difference between the total interest Zoe has paid so far on the revolving credit and the total interest she paid on the installment loan? Why is there a difference? The correct answer is $30.62. Here's why. Interest on the revolving credit equaled $96.82. Interest on the installment loan equals $66.20. 96.82 minus 66.20 equals $30.62. Zoe has paid $30.62 more so far on the revolving credit. She will likely pay even more interest because she still owes some of the debt. Paying only the minimum monthly payment means it takes Zoe longer to reduce the principal than if she paid more each month. You can follow along on page 13 in the participant guide. Loan and credit agreements may also have fees. Fees are additional charges. They are not interest. For example, credit cards may have an annual fee for late payments, fee for going over the credit limit, and perhaps other fees. Car loans may have a documentation fee, closing fee, and perhaps other fees. Make sure you understand the fees you will be charged to get and continue to have the loan or revolving credit. the fees you may be charged if you do not repay the loan or credit agreement as agreed. Prepayment is the early repayment of all or part of a loan. When you prepay, you pay the lender more than your monthly payment and have them apply the extra amount to your outstanding balance. Prepayment is one strategy for reducing the cost of borrowing money. If you prepay your loan in full, you will not pay any more interest because you no longer owe any money. If you prepay part of the loan, you generally pay less money in interest, and you may finish paying off your loan earlier. Lenders sometimes charge a prepayment penalty. Find out whether your loan terms include prepayment penalties before using this strategy to pay down your debt. Remember, the key takeaway from this section: consider how debt works so you can make informed decisions about it. Section 3, Reducing Debt, begins on page 14 of the participant guide. We will discuss strategies for reducing debt and where to get help managing debt. The key takeaway from this section is develop a plan to reduce your debt and get help if needed, such as from a trained credit counselor. Many of us want to reduce debt. It's not always easy, but it can be an important financial goal that is worth the effort. There are two general strategies for reducing debt. Number one is the high-cost debt first method, in which you pay off the debt that has the highest cost to you. That is usually the debt with the highest interest rate. Secondly, the snowball method, in which you can pay off the debt with the lowest balance first. Note that both strategies work best if you avoid incurring more debt while you work to pay down the debt you have. Neither strategy is better for everyone. It depends on your situation and preferences. We'll talk more about the advantages and disadvantages of these strategies and how they work. Turn to Apply It, My Plan to Reduce My Debt on page 15 in your participant guide. We will go through both of these methods while you follow along in your participant guide. Then we will practice using these methods together. The high-cost debt first method has the advantage of saving you money because you pay less interest. The disadvantage is progress may feel slower. Here's how it works. List your debts in order from the highest cost to you to the lowest. The highest cost debt is usually the debt with the highest interest rate. For credit cards, you can find the interest rate on your monthly statements. For other loans, you can find it in the documents you received when you first took out the loan. It may also be on your account statement if you get one. If you are still unable to find the rate, contact the lender and ask. Pay the amount due on each debt you listed so the lender receives it by its due date. For example, this can be the minimum monthly payment for a credit card or the regular monthly payment for a loan. You can often set up automatic payments so that you can be confident the lender will always be receiving the amount due by the due date. Then, if possible, make an extra payment to the first debt on your list. That will be the one with the highest cost to you. Ask the lender if you can specify that your extra payment must be applied to the principal. If the answer is yes, ask what you need to do to make the request. After you pay off the first debt, make that extra payment to the next debt on the list. Continue as needed. You can use the high-cost debt first method worksheet in your participant guide to help organize your debts if you like this approach. The snowball method has the advantage of making progress faster by eliminating small debts first. This can be motivating. The disadvantage is you may pay more money because you're likely not paying off the costliest debts first. Here's how it works. List your debts in order from the lowest remaining balance to the highest. Pay the amount due on each debt you listed so the lender receives it by its due date. You can often set up automatic payments so you can be confident the lender will always be receiving the amount due by the due date. Then, make an extra payment to the first debt on your list. That will be the one with the lowest balance. Ask the lender if you can specify that your extra payment must be applied to the principal. If the answer is yes, ask what you need to do to make that request. After you pay off the first debt, Make that extra payment to the next debt on the list. Continue as needed. You can use the snowball method worksheet in your participant guide to help organize your debts if you like this approach. Turn to Try It, Making a Plan to Reduce Debts on page 19 in the participant guide. This is an activity to do at home that shows the differences between the two methods of debt reduction we reviewed. If you're needing help managing debt, consider seeking help from a nonprofit credit counseling organization. They can help you develop a plan to manage your debt. Search using the term credit counseling at www.usa.gov for resources that include tips from the Federal Trade Commission on how to find and choose a credit counselor. Always choose where you get help carefully. Debt settlement companies and debt consolidation loans offer help and relief with debt. Before using these services, be sure you understand them, because some services you may be offered can be costly. Debt settlement companies offer to make deals with the creditors to reduce the debt you owe. Ask questions about their fees and processes. What fees would you pay, especially upfront fees? Charging a fee before settling at least one of your debts is illegal for most debt settlement companies. What will they do for you? If they tell you to stop paying your creditors and you do so, you may end up in more debt than when you started. This may lower your credit scores, add late fees and interest to your accounts, or cause creditors or debt collectors to sue you. Find more information by visiting www.consumerfinance.gov and search for debt settlement. Debt consolidation means taking out one loan and using it to pay off multiple debts. You may be able to get a debt consolidation loan from a bank, a credit union, a nonprofit organization, or a private finance company. Debt consolidation loans may cost you more than the loans they replace. Ask questions about interest rates, fees, and other costs. The low interest rates for debt consolidation loans may seem like a teaser rate that only lasts for a certain time. After that, your lender may increase the rate you must pay. The loan may also include fees or costs you would not have to pay if you continued making your other payments. Although your monthly payment might be lower, it may be because you're paying over a longer time. This could mean you will pay more money overall. Page 22 of the participant guide has a checklist of things to watch out for when getting help for debt. Be sure to review this before consulting with an agency to help you reduce debt. Remember the key takeaway from this section. Develop a plan to reduce your debt and get help if needed, such as from a trained credit counselor. Section 4, Non-Payment of Debts and Debts in Collection, begins on page 24 of the participant guide. We will discuss what can happen if debts are not paid and how to deal with debts in collection. The key takeaway from this section is don't ignore a debt collector. Make sure any debt you are asked to pay is valid as soon as possible, and get help if you need it. As long as you pay your debts on time and as agreed, your debts are considered to be current and you will eventually pay off what you owe. The life cycle of debt is different if you are not current on payments. If you fall behind on payments, your debts are considered to be delinquent. Your account may be described as being 30 days delinquent, 60 days delinquent, or more. If you continue to fall behind on payments, your debts are considered to be in default. For some loans, you may be in default as soon as you miss one payment. For others, it may take many days, weeks, or months of non-payment before you are considered in default. After a debt is in default, some creditors will then charge off your account. They give up trying to collect the debt from you directly, and they likely will assign or sell your account to a debt collector. This means your debt is in collections. A debt collector will likely be primarily responsible for trying to collect the debt. What can happen if you don't pay your debts? Several things can happen if you don't pay your debts when they are due. They can include having to pay late fees or paying more money in interest, being contacted by a debt collector who asks you to make payment. While you have rights when a debt collector is trying to seek payment from you, getting phone calls and letters from debt collectors can still be stressful. Losing services and having to pay costs to reestablish them, including higher deposits. Utilities and other services will likely be suspended if you don't pay the bills or make other arrangements to handle the balance. Losing collateral, including assets that you took out the loans to purchase, such as cars or homes. If you have a secured loan and you don't make the loan payments on time and as agreed, you could lose the collateral. For example, non-payment of an auto loan may result in your car being repossessed. Non-payment of a mortgage may result in losing your home. Other things can happen if you don't pay your debt when they are due, such as negative entries on your credit reports. If someone co-signed the loan, their credit reports may be affected as well. Drop in credit scores. Lawsuits from creditors. Never ignore these. Get legal help. If you don't show up to defend yourself, the courts will likely fine for the creditor. Wage garnishment. Part of your paycheck can be withheld for repayment of some debts. Most garnishments are made by court order. Account garnishment. Money in your account at a financial institution can be collected for repayment of some debts. Treasury offset. All or part of your tax refunds or other governmental payments can be taken from any debt you owe to the federal government, debts related to federal student loans, and court-ordered child support. Turn to Apply It, Dealing with My Debts and Collection on page 26 in your participant guide. If one of your debts has gone to collections, you can use this checklist to make sure you are paying what you actually owe and send in payments only to someone who can legitimately collect the debt. Before making a plan to pay a debt, be sure you know who you owe your debt to. The statute of limitations has not expired. The statute of limitations is a state law that limits the length of time a creditor can collect a debt. And lastly, you are dealing with a legitimate debt collector. If the debt is legitimate, but you think the collector may not be, contact your creditor about the calls. Share the information you have about the suspicious calls and find out who, if anyone, the creditor has authorized to collect the debt. If you know those three things, then pay the debt in full if possible. If payment in full is not possible, you may be able to set up a payment plan or negotiate a lower balance. When setting up a payment plan with the debt collector to pay the amount due in installments over time, make sure it's a plan you can afford. When negotiating a lower balance that will be considered payment in full, ask that the account be notated as paid in full on your credit report and not settled. Debt collectors must follow rules. The Fair Debt Collection Practices Act governs the federal standards debt collectors must follow. Debt collectors cannot use abusive, unfair, or deceptive practices to collect money from you. For example, they can't contact you at inconvenient times or places, such as before 8 o'clock in the morning or after 9 o'clock at night, unless you agree to it. They can't contact you at work if they're told, orally or in writing, that you're not allowed to get calls there. They cannot use threats of violence, and they cannot use obscene or profane language. Go to the Federal Trade Commission's website at www.ftc.gov and search for Consumer Information Debt Collection to learn more about the rules debt collectors must follow. Report problems with a debt collector to your state attorney general's office. Find your state attorney generals on the National Association of Attorney Generals website at http://naag.org. Many states also have their own debt collection laws. Your state attorney general's office can also help you learn about your rights that you may have under your state laws. You can also report problems to the Federal Trade Commission at www.ftc.gov and the Bureau of Consumer Financial Protection at www.consumerfinance.gov. Remember the key takeaway from this section. Don't ignore a debt collector. Make sure any debt you are asked to pay is valid as soon as possible, and get help if you need it. The next section is managing medical debt and starts on page 37 of the participant guide. We will discuss why medical debt is unique and how you can manage it. The key takeaway from this section is if you receive a medical bill, make sure it is valid. If you can't afford to pay it, try to set up a payment plan. Medical debt is the result of not paying medical bills when they are due. You don't start out with debt when you receive medical care. You receive the care and then receive the bill. If you don't pay the bill when it's due, then you will have medical debt. For some people, the worry about medical debt adds to their stress about the medical issue they are facing. Why do medical bills often turn into medical debt? You can take notes on page 37 in your participant guide. Medical care is often unplanned. Therefore, medical bills are often unplanned. For that reason, people may not have saved money to pay the bills. The total cost of medical care is usually not known up front. Further, the nature of medical care is not well suited to comparison shopping. Medical expenses can quickly add up. Even with insurance, you are likely responsible for some portion of the bill. Being uninsured or being underinsured often means you are asked to pay more of the cost of medical care. Medical bills can be confusing. There are usually many individuals providing medical services, and they work for different companies or independent providers. One episode of care may result in multiple bills being sent at different times. Bills may lack the level of understandable detail that you need to verify the accuracy of the bill. The healthcare providers or providers may not know from the start if you have insurance. Even if they know you have insurance, the healthcare provider or providers may not know what your required payment will be. You may receive a bill for more than you owe, and it may go to collections before the insurance details have been finalized. Turn to Apply It, taking action on medical debt on page 38 in your participant guide. This tool has some great information for you to review at home regarding medical debt. The three nationwide credit reporting agencies do not place medical debt on credit reports until 180 days after the first missed payment. This gives you time to try to find a resolution for the balance due before your credit is affected. However, even before your credit is affected, your healthcare provider or insurance company may send the bill to collections if you do not pay it by the due date on the bill. This could be an internal department or business specializing in debt collection called a third-party debt collector. Credit scores are developed based on information in your credit reports. There are multiple producers of credit scores, and they do not all factor medical debt into their scores the same way. One particularly well-known provider of credit scores is the Fair Isaac Corporation, or FICO. Medical debt that went into collections but has since been paid is not a factor in most FICO scores. Unpaid medical debt that is in collections is a factor in FICO scores, but it has a smaller impact than other kinds of unpaid debt in collections. Turn to Try It, What to Do About Medical Debt on page 41 in the participant guide. We will review this scenario together. In the scenario, Luther has medical bills. Luther has multiple injuries after falling off a ladder at his home. He has basic health insurance. After 3 surgeries, the bills started coming in the mail. He just put the bills in a drawer and decided to deal with them when he was feeling better. What steps can Luther take to reduce the chance that his medical bills will go into a debt collector? Stop ignoring the bills. Review all of his bills and make sure he has received the services on the bills. Contact his insurance company to find out what portion of the bills, if any, he is responsible for paying. See if a payment plan is possible. Get help from a credit counseling organization. See whether there are any programs available in his community that could help him. The hospital where surgeries were performed may have a program to help individuals who are unable to pay their hospital bills. Remember the key takeaway from this section. If you receive a medical bill, make sure it is valid. If you can't afford to pay it, try to set up a payment plan. The next section begins on page 42, and we will discuss what high-cost debt is and where it comes from, and alternatives to high-cost debt. The key takeaway from this section is understand how high-cost debt works. Identify low-cost options for the future. Loans with higher interest rates may be referred as high-cost debt. High-cost debt is usually the result of small-dollar short-term loans that have either costly fees or high interest rates or both. There are risks as well as benefits associated with all financial products and services, including high-cost debt. Understanding how different financial products work as well as the risks and benefits associated with them can help you make informed choices. There are several types of high-cost debt, and we'll talk about payday loans, vehicle title loans, and pawn shop loans. A car or vehicle title loan is generally a loan for a small amount of money and for a short time. To get one, you give the lender the title of your vehicle, for example, your car, truck, or motorcycle. Our discussion will focus on car title loans and are due within about 30 days. These loans can also be called single payment car title loans because they are designed to be repaid in a single payment. If you have another type of car title loan, such as one that you repay in installments over time, the information in this section may still be helpful. Single payment title loans are often due within 30 days but can be shorter or longer. These loans can be very expensive. Lenders charge a monthly fee. This fee can be 25% or more of the amount you borrow each month. If you cannot repay the money you owe, the lender can take your vehicle. If you can't pay off the loan in full when due, the lender may offer to roll over the loan into a new loan. That process adds fees and interest to the amount you originally borrowed. 1 in 5 single payment vehicle title loan borrowers has their vehicle taken back by the lender when they cannot repay their loans, according to the Bureau of Consumer Financial Protection. A payday or payday advance loan is a short-term, small-dollar loan. You borrow money now based on the expectation that you'll pay off the loan when you get your next paycheck. While payday loans were traditionally distributed throughout storefront retail outlets, they are now also widely available on the internet. A typical payday loan works like this. First, you visit a payday lender in person or online to get a new loan. Or you might be re-borrowing a prior loan from the payday lender. I will explain re-borrowing in a moment. Next, you generally write a check dated 14 to 30 days in the future, which is usually the date you expect to receive your paycheck, for the amount of money you are borrowing plus fees. Or you agree to allow the lender to electronically debit your checking or savings account for that amount on a specific date, usually your payday. After that, the lender gives you the amount of the loan. If you don't have the money to repay the loan when it's due, you may be able to re-borrow the money, usually with additional fees added. Re-borrowing can also be called renewing, rolling over, or extending the loan. Sometimes the loan may automatically renew unless you tell the lender that you do not want it to renew. Generally, the longer it takes you to repay the loan, the more costly it will be. Many state laws set a maximum amount for payday loan fees ranging from $10 to $30 for every $100 borrowed. A typical 2-week payday loan with a fee of $15 per $100 borrowed equates to an APR, or annual percentage rate, of almost 400%. By comparison, the annual percentage rate for credit cards often ranges from about 12% or lower to about 30% at the highest. When you borrow money using a pawn shop loan, the debt is secured with an item you have pawned. That item is the collateral for the loan. The pawn shop physically holds the item during the loan. If you don't repay or renew the loan, expect the pawn shop to keep your item and sell it. The amount of money you can borrow from a pawn shop is based on the resale value of the item you put up for collateral. A typical pawn shop will let you borrow 25% to 50% of how much they consider the item to be worth. For example, the pawn shop values the item you want to pawn at $300. You may be able to get a loan of $75 to $150 in cash. At the end of the loan term, usually 30 days, you must repay the loan, renew it, or lose the item. Renewing the loan will likely cost you an additional money. A pawn shop loan is different than selling an item to a pawn shop. After that, the lender gives you the amount of the loan. If you don't have the money to repay the loan when it's due, you may be able to re-borrow the money, usually with additional fees added. Re-borrowing can also be called renewing, rolling over, or extending the loan. Sometimes the loan may automatically renew unless you tell the lender that you do not want it to renew. Generally, the longer it takes you to repay the loan, the more costly it will be. Many state laws set a maximum amount for payday loan fees ranging from $10 to $30 for every $100 borrowed. A typical 2-week payday loan with a fee of $15 per $100 borrowed equates to an APR, or annual percentage rate, of almost 400%. By comparison, the annual percentage rate for credit cards often ranges from about 12% or lower to about 30% at the highest. Remember the key takeaway from this section. Understand how high-cost debt works. Identify lower-cost options for the future. Thank you so much for joining us for this specially crafted course that discussed managing debt.